Now, looking at the loan stock or the typical bond holders of the company, they are more like creditors, right? They are not the owners. They have lent money. So, because of the loan that they have given, they want the interest and the principal payments at regular intervals of time, right? As per the deed, as per the agreement that is set out at the beginning of the loan itself. Generally, there might be a periodic interest payment, and at the maturity period, there may be a principal repayment that is happening. So, because they are not the owners, they don't have any kind of voting rights. But generally, what they have to receive, the interest and the principal, that is very clearly mentioned in the trust agreement or trust deed. And generally, the trustee is appointed to take care of the interest of all the bondholders. And the trust deed talks about all the kinds of rights with the typical bondholders of a particular company are going to have. So this regular interest which they are going to receive, in general, it could be on an annual basis every year, or in some cases it is on a semi-annual basis. Again, in some countries it is more annual, in some countries it is more semi-annual. But whatever is that regular periodic interest that is received is typically called as a coupon, and the principal repayment on the maturity date. And this coupon generally is fixed in nature, which would be some proportion or some percentage of the face value of the bond. And a majority of these bonds are even tradable. So the demand and supply changes, and because of it, the market price of the bond also changes. But the major driver of the price of the bond, what we generally see is the price and the interest rate. Now, if I see the market interest rate and the price, I see such kind of inverse relationship existing between the two. So, as the interest rates are increasing heavily, the price of this bond in the market is going to fall, and that is what could result in a loss for the lender, right? And if depending on the coupon that has been used for the issue, the price could be very much different from the par value or very close to the par value. If the coupon that is going to be paid is very much lesser than the interest rate, we see that the bond would be sold at a discount to the par value. But if the coupon that is going to be paid every year or every 6 months is much greater than the interest rate, then the bond would be sold at a premium. But the more and the more the coupon that is going to be paid is somewhere around the interest rate itself, is very much closer to the market interest rate, then the bond would be sold more or less close to the par. And whenever it is sold closer to the par, there is nothing much of a capital gain, right? Because a company is going to pay off the interest at regular intervals and principal on maturity. Oh, it's only in the form of coupon that the receipts are occurring, and there is nothing much of capital gains. So if the coupons are higher, it's as good as saying that the running yields are high. Probably in a equity, the dividends are much lower. So because of that, the running yields are going to be much lower in case of equity, whereas in case of bond, if the coupon is a decent number, even if it is lesser than the interest rate, if the coupon is going to be a higher value, the running yield is going to be much higher compared to the equity. But the capital gain is much lesser. So, if we are typically combining these two forms of a return into a total return, we might still see from a total return perspective, the bond is having, the loans are having much lesser value compared to the total return on equity. For one of the simple reasons, the bond is slightly or is much less risky, even though it is issued by the same companies. Bond is visualized as less risky compared to the equity, and because of that reason, even the return is going to be much lesser for the bond investors. So, and one more reason could be the bond investors typically they are not participating in the business. They are really not bothered whether the business is making a profit or not. For them, it is mandatory that they have to receive the interest and the principal payments on time. Otherwise, it would be considered as a part of default. So, because of the less risk that is built into the bond investors, obviously they are offering more security. So, the overall expected return can be lesser for those kind of investments. And coming to the other dimension of marketability, compared to the equity, the marketability for the bonds is going to be much lesser. Government, even compared to look at government bonds, again within the bonds also, the government bond, the treasury based securities have much higher marketability to compared to the corporate kind of bonds which have a slightly lesser marketing abilities, right? So in general, the bonds are another way, another major mechanism that is being used by the companies to raise the capital. So this constitutes a part of the debt, major part of the debt capital, and shares issuing constitutes a major part of the equity capital. And these two contribute to a large portion of the capital that is raised by majority of the companies. All right.